Hello and welcome to the very first episode of the Future Homeowner Show. This is a show that is made specifically for those who are seeking to buy their first home, to work on getting their finances together, their credit, finding out about different down payment assistance programs, and whatever it takes to buy that first home and getting the keys to your first home. We wanted to do something different. If you're familiar with homeowner prep and our history over the last few years, you know that we did have a full season of the homeowner prep podcast, which was 100 episodes. And that season was strong. We had a lot of views. We had, I think, about 300,000 views on YouTube. We had a lot of downloads of the podcast. But that podcast was meant specifically to deliver education and to really break down the process of buying a home from the standpoint of we're going to teach you step by step. And that's what that podcast was all about. So if you haven't seen that, you can visit our YouTube page, the Homeowner Prep YouTube page, in order to look into those past episodes of the Homeowner Prep podcast. But we moved on from there because we pretty much delivered content that anybody can go back to and learn how to buy their first home and the step-by-step process. But we wanted to do something different, something to keep you up to date as to what's going on and help you with your finances as well. So from there, we actually launched another podcast, which was called the Just Got Paid podcast. Now, that was doing good. We had a couple interviews on there, but the difference was the audience. The audience that we had that was viewing that podcast, that was listening to that podcast, wasn't quite the audience that we wanted. We really wanted to cater only to first-time homeowners. And what we found was there was a lot of people who were already homeowners that were listening to the content because it was more centered on financial literacy. We talked about taxes, we talked about insurance, all these different things. But again, it wasn't catering to the audience that we are truly looking to serve. So we did stop with that podcast and we wanted to kind of go back to the drawing board, figure out how is it that we can reach the folks that we truly want to reach and make sure that we're helping them not only understand how to buy a home, but understand what's in the news and how it may impact their ability to buy their first home. In addition to that, we wanted to answer questions directly. I get a lot of questions throughout the week from aspiring homeowners. We hear from folks who reach out all the time, whether it be on social media or text message, calls, emails. And those questions are great. We love to get those questions and we're answering them and we're helping people. We meet with folks, we have strategy sessions, we do the things that we want to do to make sure that we're helping people. But a lot of those same questions you may have as a listener, or you may be thinking about and you don't know what necessarily to ask, what questions to ask. I always say there's no such thing as a stupid question because we really have to break things down. And when it comes to buying a home, it's so personalized. You know, you have different challenges from somebody else, and yet you may have some similar challenges. And so when we get some of these questions, we wanted to just be able to answer them cleanly, clearly, making sure that we're not only helping the person who asked, but we're helping those who should ask or maybe thinking about asking, but don't quite have the confidence or the courage to reach out and ask the questions themselves. So, what we're doing right now is putting together this podcast. This is the Future Homeowner Show. This is all about you. If you are looking to buy your first home, how are you, interpreting the news, the changes in the economy? Are you feeling challenged by them? Do you feel like home ownership is even possible? We talked to a lot of folks who are kind of losing hope in home ownership. And so we want to break down some headlines, and that's really the pulse of the market. When we talk about the segments of this show, that's going to be the pulse of the market. We'll go through a few articles that we feel are relevant to your journey in buying a home. Another segment that we do want to jump into is really doing a deep dive on a particular subject or topic because we feel like there are issues, there are new changes that come about, and you may hear them and you may not realize how important or how beneficial they are to helping you in your process to buy a home. So we'll be doing that as well in our second segment, that is the deep dive. And then lastly, we do want to have a Q&A. Ideally, I would love for this to be a live Q&A. We know people are busy. Not everybody's going to jump onto the live stream. Some people are going to listen to this podcast while they're driving, or a week later, whatever the case may be, and that's fine. But we are going to address some questions that have come to us via email or through DMs on our social media. So we'll address those, but there will be some time set aside in every episode to answer direct questions. We call it real questions, real answers. So that'll be the third segment of our show. So let's go ahead and dive into it, because I really want to talk about some of the recent news that's out there and help you understand how it may be impacting you as a first-time home buyer. So let's get a pulse of the market here. Now, the first the first article that I want to cover is this article here. It came out from Realtor.com, and it says that lower mortgage rates and higher rising listings arrive at a crucial point for spring buyers. Now, normally the springtime is a great time for people to be out buying. That's typically when you see a lot of movement. And the reason for that is because people start to think about plans for the next school year. They start to look at, hey, it's springtime. Traditionally, you have better weather. So buyers are out and they're looking to buy during that time. So we see a lot of movement during the spring. But one of the things that we're seeing right now is, interest rates are climbing. Now, the Federal Reserve just came out and said that they're going to keep rates steady. They're not going to increase or decrease, which is good news. But rates are on the higher side. And I say that with air quotes because it depends on a lot of different scenarios, and I'll kind of touch base on those. But inventory is coming up. And that's an industry word that just means there are more homes on the market than there were a year ago. And so when we look at inventory hitting the market, new listings are available. We're seeing that mortgage rates are still elevated. I won't say high, but they are elevated. And these homes are sitting on the market longer because of these economic factors. Now, I will say this, the buyers that I talk to have a lot of uncertainty. They're worried about, what's going on not only in our economy, but, the rumors of war. There's things that are going on overseas. There's a lot of job cuts that are taking place. And so folks are really feeling uncertain about where things are going, and that may cause them to not take action, but not you, because you're going to be equipped to take action in today's market. But that's really what this article is talking about. There is price growth and some slowing in markets depending on where you're at in the U.S. But really this means that you as a buyer, you have more negotiating power. When homes listings are sitting on the market longer, the sellers get even more motivated, because you have to realize that sellers are listing their home with a plan. Nobody just puts their home up on the market without a plan. So whether that plan is to see how much money they can get, or they're moving out of state, or they have a job transfer, or whatever the case may be, there is a plan in motion. And so as a seller, you want to sell your home as quickly as possible so you can move on to the next phase of that plan. When the home is sitting there, the sellers start to get a little anxious. They start to wonder, is their home good enough? Did they price it right? What's going on? Why isn't their home selling in comparison to maybe some of their neighbors, or whatever the case may be? So as a buyer, this presents a great opportunity for you. When you go in to negotiate or make an offer on a property, if you go and you see the place and you see that it's been sitting on the market for a long time, and your agent is talking to their agent trying to get a motivation as to, what's going on, why isn't it moving, what's the situation with the seller, you can really get a better understanding of their motivation and how willing they would be to possibly take a lower offer or give you some credits for your closing costs or helping with down payment or with your rate. So what do I mean by that? If the house was listed for 500,000, it's been sitting on the market for 90 days, you could potentially come in lower, say like a 475, 480, whatever the case may be. You can get as aggressive as you want and see what they counter you back at. So opportunity to buy the house for less than what they're asking. Another thing is, there's a lot of issues that, this article was talking about interest rates and them being elevated. There's opportunities for sellers to actually buy down your rate. I have a listing that recently was offering this. So if you are going in on that same $500,000 property and the interest rate that your lender is giving you is say 6.5, if you can negotiate with the seller to buy down your rate for a 2-1 buy down, you could be paying 4.5 for the first year and then 5.5 the second year. And then by the third year, you'd be paying the 6.5. But what that does is it gives you lower mortgage payments for those first 2 years. Also gives you time to increase your income on the job. And so, you might be in a better financial position during that time. So there's real opportunities, and that does come with a cost that the seller can pay for. So you can utilize this opportunity where you have a slower market to maybe capture an opportunity for the seller to contribute to lowering your rate. And then, of course, you do have closing costs with every purchase. So if you have closing costs, the seller can pitch in to pay for your closing costs as well. And so that presents another opportunity. The other thing to think about when you're dealing with homes that are sitting on the market is that you're not dealing with a bidding war. I don't know if you remember during COVID years, there were a lot of people putting in offers. They were putting in offers way above asking price. Sometimes they didn't even see the house. Sometimes they were waiving their appraisal contingency, which is kind of like your insurance when you're buying to make sure you're not overpaying for a home. And they were doing any and everything to purchase a home. And so what that does is it actually creates this bidding war, this emotional tie where everybody's kind of just throwing their offers in the hat and seeing if they can get the place. And so with that not happening today, because we have a slower market, it gives you an opportunity as a buyer to not have to be bidding against 10, 20 offers and give you a real opportunity to actually get the home that you truly want. So keep that in mind. But just know this is a shift. Markets do shift. The market's not going crazy. It's not a crazy competitive time like it was before. So if you've been waiting, kind of sitting on the sideline and kind of figuring out when's your right time or your right window, this might be it. So definitely consider this as good news as a buyer. Let's jump into this second interview, because the second article I thought was very interesting. We're in a time right now where there are a lot of folks who depend on information from the internet, whether it's Instagram or TikTok or wherever it is. There's a lot of these influencers. They call them finfluencers, right? Financial influencers. And unfortunately, a lot of these folks are just scammers. And so you have to be protective of your information, for one, of paying anybody, of sending any money, anything like that, and making sure that they're the real deal. So I thought this article was interesting. Just came out about this guy. He was quote unquote a finfluencer, Tyler Bossetti, and he recently got convicted for 6 years and a $20 million Ponzi scheme for what he was doing. Now, basically what he was doing was he was saying he's a real estate investor. He was running this Ponzi scheme promising big returns. And that's always kind of like the first red flag. If they're, 30% returns guaranteed, be careful. But they use a Ponzi scheme is basically taking in new investor money and using it to pay the returns that you promised old investors. That's a Ponzi scheme. It's a cycle. So old investors think that they're actually profiting, but they're not. They're just getting that new investor money, and that's how they're paying them. So he was sentenced to prison, like I said, 6 years. These are not real opportunities. We just talked about a real opportunity in the market. This is not. I know a lot of folks who are, thinking about buying their first home, but then they're like, oh, well, let me get some income so I can have some savings. So they might get into some type of investing. There's nothing wrong with investing in stock market, things of that nature, but just be careful when you start to look at these Ponzi-like environments where folks are promising big returns, promising quick returns. There's no get rich quick scheme when it comes to real estate. I know a lot of people try to overpromise and under deliver, unfortunately, but this isn't new. There are a ton of these types of scams that go on. I had just did a live video not too long ago about one in the San Diego area, but these things go, they're happening every day. Unfortunately, people are being taken advantage of, and these guys, they earn their living by taking in more and more money from investors. And unfortunately, these investors are giving up their hard-earned savings, their retirement funds. So if you're a first-time home buyer, you're just trying to get some investing so that you can have some money to put down on your first home, look at other opportunities. Don't fall for these Ponzi schemes. Look at something much more stable, like the traditional stock market. Getting into, seeing what are your Roth IRA, what is that doing? Just look at things that are true and time tested. Don't fall for these influencers that are on social media, because oftentimes they are scammers for sure. So if it sounds too good to be true, it usually is. But real estate is about building wealth. It's not about this quick, a lot of people flip real estate. That's one thing, but just be careful where you put your money. If you ever have questions about should you invest your money in something or some program or some company or individual, we help a lot of our clients. We've helped them kind of analyze different things. We do some research for them, find out if they're scams, and we saved some clients a ton of money, their retirement funds, by keeping them out of these programs. So do your due diligence, work with licensed professionals. You can always just check, real estate licenses, things of that nature, and reach out and ask questions. Like I said, if you're thinking about getting into, or if you looked at these as a potential for you to build income. Now, this third article is actually pretty interesting. So if you're not familiar with the different types of real estate, there's one that's kind of being pitched as maybe the next phase, and that is factory-built manufactured homes. Now, what they do with manufactured homes is they basically put them all together in a factory, on a factory line, and then they deliver them to a site. And then they basically, they connect all the utilities and the water and all these other things to the home once it's on site. Now, people are feeling like, hey, this might be an opportunity for first-time home buyers because it costs a lot less to build these types of homes. So, this might be an opportunity to where we can build more homes faster. We have a shortfall. One thing that this article talked about was, we have a shortfall of 4 million homes a year. So there are people who want to buy homes, and unfortunately, there's not homes available to them. And what that does is that keeps prices inflated because there's a lack of supply and an increased demand. So when we talk about home affordability and things of that nature, we got to find ways to get more homes to the market. We have a lot of people who want to buy, and unfortunately, there's just no opportunities for them to buy. So this might be a viable opportunity. The issue that you have to be aware of when it comes to manufactured homes is, does your lending approve you to buy a manufactured home? So there are mobile homes, there's manufactured homes, and then there's your traditional homes. Some financing, like if you're using a VA home loan, they require you to buy a property that is permanently attached to a foundation. So is the manufactured home permanently attached to a foundation? The answer to that question might determine the type of financing that you can use. So if you got approved for a VA home loan, you may not be able to use it on a property that has maybe rental lease, where you're renting the land that the home is sitting on. And so you have to be mindful of that. I always say talk to your lender first and foremost about the restrictions of the loan program that they got you qualified for. And then also talk to your real estate agent. give them the information. They should already be in communication with your lender and know your financing. But when you're looking at homes online, you may not know the difference. You may not know the difference between a manufactured home and traditional. So as you're sending those to your agent, and if they know that you're using VA and they know the restrictions and what you need to be looking for, they're going to be able to steer you in the right direction. But if you are approved for a lending program that allows you to buy a manufactured home, it might be an opportunity for you to get your foot in the door. I know it's not the dream home. I'm very aware of that. Oftentimes people are looking to buy their dream home right out the gate, and that's just not realistic. Based on budget, based on your rates, based on your income or debts or whatever the case may be, you're going to be approved at a certain amount, and that amount may not get you into the door of your dream home, but it might get you into the door of a condo, a manufactured home, or maybe even an ADU that's now available for sale. So look at all the opportunities to get your foot in the door, to become a homeowner, to stop paying somebody else's mortgage, so that way you can start building some generational wealth for you and your family. So this might be an opportunity. Like I said, it may be a solution. We definitely have a shortfall. The shortfall creates a problem with affordability, so we have to address that. It's lower cost to put these homes together, so that means lower cost to you as a buyer when you're turning around to buy it. And they can build these homes a lot faster, so they can get homes out quicker. So keep that in mind. These are entry points to home ownership, if you would. So it doesn't start with your dream home, doesn't have to start with your dream home, but you got to start with your first home. You got to get your foot in the door. And so that would be my advice when it comes to looking at manufactured homes, if that's the avenue that you can take. Now, those are just a few of the articles. I know there are headlines released every single day. As I mentioned before, we're always available. If you're not already following us on social media, you definitely should. We're on Instagram, Facebook, LinkedIn, and YouTube at Homeowner Prep. So feel free to DM us. You can send us, a headline, a news article that you read. These are things that happen all the time for us. We have our clients that do the same thing, but we're opening that up to you as a listener or viewer of this show, because we truly want to make sure you're getting the right information when you're reading these headlines and interpreting them the right way. I have over 20 years in this business. We've kind of seen it all. On our board, we have real estate investors, we have construction companies, we have educators, we have a team of people who can look at and analyze situations or articles or any situation that you might be in or challenge you may be facing, and be able to provide you with some expert and professional advice moving forward. You don't have to take our advice. We're not going to tell you what to do. We're just going to make a suggestion as to how you should be interpreting it or how you should move forward in your particular situation. So don't hesitate. If you see a headline out there, you want to send it our way, find out what's truly going on and how it impacts you, send it to us. The best way to do that is to send us a DM. So that is our pulse, our market pulse. And I want to get into the next segment of the show. This next segment is all about taking a deep dive and a deeper look at some recent news that came out. Now, this news does impact a lot of first-time home buyers, more so than any other news that I've heard recently. And so I took a few notes. I did some research on this, and I really want you to understand how this is going to impact you in your transition from renting to home ownership. And the deep dive topic that I want to touch on is this new scoring model called VantageScore. Not sure if you've heard of this or not, but VantageScore is a scoring model that was created by your three credit bureaus. So you have Experian, Equifax, and TransUnion. These are your three credit bureaus. They traditionally use a FICO score to qualify you for your home mortgage. So when a lender is pulling your credit, they're looking at your three scores from these credit bureaus, and they're using the middle score to qualify you for a rate or a program. Okay. So if your lender pulls your credit and they see that you have a 600, 620, 630, they're going to use the 620 as your credit score. And that 620 is going to qualify you for certain rates and certain programs. And so that's how credit has been done for years. FICO has been used. And so recent news came out saying that Fannie Mae and Freddie Mac, who are the big government programs that actually buy your loan when you're doing like an FHA program, and they're saying that we're going to allow buyers to utilize the VantageScore scoring model in order to buy a home. So, what's different about this VantageScore? It was created by the bureaus, the same bureaus, but it uses different criteria. So, people can have better scores with limited history. That's always been a big issue for people who are looking to transition from renting to buying. They'll say, well, I don't really have credit. I never really built credit. And oftentimes, when you're going in looking to buy a home, you oftentimes had to have 2 or 3 lines of credit in order to even buy. So you had to have a credit card and car payment, student loan, whatever the case is. You needed to have 2 to 3 lines of credit in order to qualify. And so that they can see some history of you making payments back to the folks that you owe. This is a debt system. I don't want you to confuse this as charity. It's a debt system. They want to make sure that you have proven that you can take on debt and that you can repay it on time consistently. You have to remember, when you're buying a home, it's the bank that owns your home until you pay it off. So they want to make sure that you can pay that loan back every single month. The bank is not in the business of owning property. They own the loan and they get the return based on the interest rate that you're paying on that loan. So they want to make sure that you can pay this off for the 15 to 30 years and that they're going to get the return on their investment. So, when it comes to repayment, we have to look at ways to establish credit sooner and ways to improve your credit so that you can have a higher score when you go to buy your first home. And that's what this VantageScore is. So think of VantageScore as another way where lenders can, evaluate your financial behavior and not just credit cards and loans. These are different ways. So they're using different things to give you that credit. And those things are your utilities and your rent. So if you are paying rent and you're paying it consistently, it can be it can actually be reported to VantageScore, and VantageScore will actually start to build a credit profile for you because you're showing that you're paying your rent on time. Same with your utilities. So we know that some people may not have a credit card, some people may not have a car loan, but oftentimes there are a lot of folks who are paying rent and they're paying their utilities. So Fannie and Freddie are allowing these rent payments, utility payments. They now count towards your credit. And they're showing that you're responsible. You're financially responsible. You've been able to pay your rent on time every single month. You're good to pay your mortgage on time every single month. And so that's what we're looking at. And this change is really going to try to help close that gap. We have a lot of folks, especially in Black and brown communities, who don't have established credit yet. And they're paying rent, they're paying their utilities, and they need a way to build credit and show that they're credit worthy of homeownership. And this is going to be that one. So it's a game changer for the community. We definitely see people paying rent for years, and now at least you're getting something in return for that. So we are expecting more people to be able to qualify for mortgages because of this. Obviously, there should be higher credit scores for these folks who have been paying rent now that they're coming into homeownership. So your first interest rate as a first-time home buyer should be higher, which is great. And then we're also looking at increased access to homeownership. So, folks who weren't able to qualify for a loan in the past, now they'll be able to. So it's not going to mean a instant approval. It doesn't guarantee that you get approved, but it does give you a stronger credit profile. So we want to make sure that you're taking advantage of this. So how do you take advantage of this? Well, right now, the way it's done is you have to use a reporting service. So there are different reporting services out there. Experian Boost is one of the bigger ones that people have probably heard of. There's another called Rent Track. There's like Rent Reporters. That part of it is still a cost. There's still a cost that's incurred. I've seen things that are maybe $10 to $25 a month. But what they do is they actually will report they're in touch with the lender. Your landlord, and then they're reporting that rent, and they're connected to the utility companies and reporting your on-time utility payments. So you have to communicate this with your landlord, so that way when you're setting up this program, you're giving them the correct information so they can report those things on your behalf. You want to make sure that that is getting reported, and then you can link the utility accounts to that reporting as well. So you have to be consistent still, still make your on-time payments. You don't want to do all these things to connect these accounts and your landlord and utility companies, and then you're late paying these bills. You still need to be on time paying these bills, because that can actually hurt you. So, step number one in this new process, or this new program, if you would, is to pull your own credit right now. You can go to annualcreditreport.com and pull it for free. I always suggest that folks go to myfico.com and pull your credit. Look at all three scores, look at your reports, see what's showing up, and make sure it's accurate. That's the first thing. Then, if you want to start reporting your utilities and your rent, look at one of these services like Experian Boost or Rent Track or one of the others. Do some research online. Find a company that you can utilize and get them connected with your landlord, and connect them to your utility programs as well, so that way they can start reporting. So pull your credit report, look at any gaps, make sure it's correct, start reporting those things right away as soon as possible, and connect with a loan officer who can really kind of show you what you should be doing with your credit report and credit repayment. This is a big one, because a lot of times I'll talk with clients. We'll have clients that come to us and they're saying, well, I don't want to buy a house until I pay all my credit off. And little do they know that everything that shows up on your credit report isn't necessarily hurting you, or is so old that it doesn't impact your score. And so you want to make sure you're paying off the right things. Don't send good money after bad debt. Your lender will be able to walk you through that. Hey, we need to address this. Let's pay this down. Let's do this. And they'll give you a strategy and a plan to pay those things down to get the best interest rate, or to qualify for the best programs. Don't just pay everything off on your credit report. Don't just pay off all your debt. That's another problem that we see. Everybody wants to just be debt free, have zero balances, and then, you can find out that actually hurts your score, or if you close an account, something like that. So talk to your lender, put a game plan together, start reporting that rent, those utilities, and start taking action as soon as possible. If you need help with finding a lender in your area, reach out to us. We can find somebody and connect them to you. So let's jump into our real questions and real answers. Hopefully you got some great information about that VantageScore and how it impacts you as a first-time home buyer. We definitely want you to take advantage of it. We think it's going to be a great opportunity for first-time home buyers. But I want to jump into this segment because we get questions on a weekly basis, sometimes on a daily basis. And as I mentioned at the top of the show, we try our best to address them right away, get right back to folks. But some of those same questions, more than one person can benefit from, hearing the answers. And so we want to make sure that we're sharing these questions. If you ever feel like you have a question you want to ask us live on these recordings. You can send us a DM. You can email us. We can be reached at contact@homeownerprep.org. But ask the question. I really want you to get the answers that you need. Oftentimes people are just sitting on these questions and it's holding them back. People are still thinking these old myths about home buying. Oh, you got to have 20%. Oh, you got to have perfect credit. All these different things. It's just not true. But if you don't ask the questions, you're not going to get the answers. So we want to make sure that you're getting real answers to real questions. So let's jump into it. So one of the first questions that I want to cover is, should I buy new construction or should I buy resale? What's the difference? So we had this question come up this week, and it was a buyer who was qualified already, and they were wondering if they should go in and buy new construction because I think they saw a commercial or something like that for a new construction home, and I think they were giving back rebates or incentives. So let's just break down the difference. So obviously, when you're buying new, the great thing is nobody's lived in the past. Doesn't mean the home is perfect, because there still could be issues that you need to address. But it's oftentimes going to be very modern. All the modern fixtures, things that people are looking for. So that's definitely a pro. Also, you're going to get like the builder incentives, things like where they're paying your closing costs, or they're giving you some credits for different things, or even getting a lower interest rate because they're the ones biting the bullet to sell the house, especially when their inventory, their homes have been sitting for a little bit. So, you do have some pros to it. The cons are, oftentimes there are going to be higher taxes that you need to be aware of. They have this thing called Mello-Roos, and your Mello-Roos needs to take care of new streets, new parks, new schools. So you may have an additional cost on that new development, and that may carry for 20 to 30 years going on into the future. So you need to ask the question, are there any Mello-Roos on the property? And that goes on to your property taxes. The other thing is, oftentimes property taxes in general are higher because of these Mello-Roos. So just keep in mind that, you may have different property tax amounts, even if it's in the same community, just because one is new and one is a resale. So property taxes may be different. So look at that. Another issue that might be more common is that you have an HOA or a higher HOA or HOA that is going to be increasing over time. So ask these questions. Is there an HOA? How much is it? Is it going up? What is it expected to be when this community is fully built out? Ask these questions ahead of time so you know all the costs before getting in. And then there could also be potential delays. You're trying to buy a house. They're telling you it's going to be ready in October. Well, if you get bad weather, that impacts the ability to actually do construction. And so that might be delaying your home from being built. So keep in mind timelines. If you definitely have to be out of a place because, your lease is ending or something like that, you need to be aware of that there could be potential delays. But overall, there are some good aspects to buying new construction. Like I mentioned the pros, but these companies are oftentimes kind of eating the cost for buyers when it's a slower market like it is right now. So go in there and talk to them and ask the questions. My only suggestion is that you go in there with your own representation. Have your own agent take you to the new construction development. And I'm not just saying that because I'm a licensed real estate broker. I'm saying that because you need to have somebody who's looking out for your best interest. If you were to walk into that sales office and talk with the agents that are there, they're licensed, but they work for the builder. So whose interest do you think they have? They're looking out for their employer, the person who pays their check. So you need to be aware of that and have your own representation. So when you're going in and having these conversations, asking these questions, you need to know that they're giving you real answers. And the best way to do that is to have your own agent. So that would be my suggestion. If you're going into new construction, just make sure you bring your own agent with you so that way you're protected. And they can also negotiate on your behalf. Oftentimes the prices that you see from these builders are not set in stone. There's still some negotiating that can take place. There are opportunities for you to get additional benefits. I remember I had a client a few years ago who went in. We were kind of looking at the last phase of development, and she was actually buying the model home. And so the builder, when they go into these communities, they build them out, they sell them in phases, they roll them out in phases. And then at the very end, they sell the model homes. And oftentimes the model homes are the priciest of the units because prices go up with each phase. But what they were doing was, hey, we're selling these are the last models. And my client was willing to, the price was in her budget, so that wasn't an issue. But I just simply asked the question of, well, what are you guys going to do with the furniture? Because every time they go to build some new development in a new community, they have all new interior decorators and they're designing and they're using all new stuff. They're not going to reuse the same furniture and the pictures and all these other things. So, I just asked the question, what are you guys going to do with it? And they said, well, we probably could sell it to you, is your client looking to buy? So I went back to my client and talked to her. I said, what do you think about the furniture and all the, finishings and whatnot? She loved them. And so we went back and we actually negotiated to buy all the furniture in the model home. I'm talking about every room, the kitchen, dining room, everywhere, pictures on the walls, everything. And my client only paid $500 for it all. So think about these things. When you have an agent representing you, asking questions from these developers and their sales team, there's going to be opportunities for negotiations to take place, and you're not necessarily going to know the right questions to ask. So just make sure you have representation going with you whenever you visit a new community for the first time. Let's jump into the second question. I'm just going to cover 3 questions today. But second question is, are interest rates going up or are they going down? And this is a common question. Unfortunately, I don't have a crystal ball. I would love to tell you where they're going and when. I think I'd make quite a bit of money if I knew that. But you have to realize a couple things about interest rates. Interest rates, number one, they change daily. They fluctuate on a daily basis. The second thing is, as I mentioned at the top of the show, the Fed came out and said they're not changing the federal interest rate. Federal interest rate does impact your interest rate as a borrower, but oftentimes your lender has already kind of baked in the expected cost or the expected, rate changes. So your rate may not change, even if you hear a headline saying that the Fed changed. So, keep that in mind. The Federal Reserve does impact interest rates on mortgages, but not in the way that you think. It's not really a direct one-for-one type of situation. Your lender is going to be able to help you and guide you through that process. So yes, your rates do change. They change daily. As you get close to buying your home, your lender will actually lock your rate. And by locking it, it protects you. So if interest rates do go up, you're locked in at that rate through your escrow and you close at the rate that was quoted to you, which is a good thing. And so you just want to be mindful of that because those interest rates can change. So I often get a follow-up question to that. Well, what if I lock my rate and the rate goes down while I'm in escrow? Well, there's a couple of scenarios. You could pay to lock a new rate. So it would cost you money to do so. But talk to your lender, figure out, okay, if I lock in today's rate, what is the expectation? How much time do I have? If I need to lock in another rate, if the rates go down, how much would that cost? These are the questions that you can ask your lender and make sure that you're, set up to lock in the best rate possible. Even if rates do change, from the time you're in escrow, they may not change a lot to where it's actually a significant difference in your payments. So, I wouldn't be held up by that. That wouldn't cause you to not take action. You should be locking your rate. As long as the rate gives you a payment that is within your budget and that you can afford, then you should be good to go. So they do change. They are influenced by this keyword inflation and the economy. And so that's what the Federal Reserve looks at is inflation, and they make their judgments based on their meetings, based on the information they're getting, based on what the economy is doing. So no one can perfectly time these rates. Keep that in mind. So focus on what you can afford now. My advice to every buyer is to talk to a lender, get pre-approved. If the lender says you are approved, congratulations. That is not a guarantee. So you need to take action and move forward with buying once you are approved. There's a time limit to these things. As I mentioned, rates do change daily. So if, let's say you're on the cusp of a great rate and rates go up and you kind of sat on it, well, you kind of missed an opportunity, and it could make a difference. If you're now looking 90 days later at, where am I qualified now, it might be $30,000, $40,000 less because rates changed on you. So you need to be mindful of that. When the bank says you're approved, trust me, you're approved, but you're approved now. You're not approved 90 days from now. You're not approved 120 days from now. So take action and make sure that that rate is a good rate where it gives you a payment that's within your budget, where you're not living to pay the mortgage. So that's my advice on rates. Again, I don't have a crystal ball. I can't tell you, where rates are going. I can tell you this, the rates today, we're in the 6s. It wasn't that long ago. We were in high 8s. You'd probably go back quite a long time when we were in double digits. Everybody talks about 2 and 3% that we saw during COVID. Personally, I don't believe we're going to see those unless there's some major economic issue. So the rates would probably be the least of our issues. um, as we look back on those times of COVID, where everybody's like, oh, that was such a great time. No, it wasn't. We were in COVID. Rates were low for a reason because there was no jobs. People were not working. The Federal Reserve was just trying to keep us afloat. And so that's why we had those interest rates. And I don't think we'll be back. Getting into the fives would be great. Getting into the fours would be amazing. But twos and threes, I just don't see it. Now, keep in mind, as I mentioned before, with a slow market, you have sellers who are willing to buy down your rate. So, like I said, if let's say you're getting 6.5, but you're taking advantage of a 2-1 buy down, well, you're paying 4.5 for that first year and 5.5 the next year, and then it goes to that 6.5. So you have time to kind of get adjusted to that rate. And save some money in those first couple of years. So just because you see a rate that's out there doesn't mean that that's the rate that you're going to pay. Depending on your credit, depending on your what we call the debt to income ratios, that could determine your rate. And then you can always buy down your rate with your lender. So don't get caught up on these interest rates that are out there in the headlines. Just realize that your rate is going to be your rate after you talk to a lender. So let me jump into another question here. How much do I need to earn in salary in order to buy a home? And this is kind of an interesting question. So what you make an income needs to be adjusted to what your debt is. I mentioned this term, debt to income ratio. I want you to know that term, know what it means, and talk to your lender about where your debt to income ratio is. We call it a DTI in the industry. So when it comes to income, yeah, income does matter, especially the income needs to be consistent. That's the biggest issue. It's so much easier to buy a home when you're like a W-2 earner. You have a standard job. You've been on the job for more than 2 years. You have paychecks and pay stubs. Very simple. When you're an entrepreneur, your income fluctuates. You're writing everything off on your taxes. You just started your business. Like that's when things get tough. So definitely talk to your lender. You want to have income, but the lender is really looking for stability in your income. Is it going up? Is it staying the same? And how much can they depend on that income lasting for the life of your loan? That's really what they're looking for. So income does matter, but your debt matters, your credit score matters, and the amount of down payment you're putting down will matter too. And this is key. So like, let's say, if you're earning, I can have two people who are both earning $100,000, but depending on their credit score, they might have different rates. Depending on how much debt they have, they might have a different rate. And depending on those two things combined, they might have different payments, in addition to how much each one of them are putting down. So if one person's putting down 3.5% and another is putting down 25%, well, obviously that 25% down payment, that mortgage is going to be a lot less. So when it comes to, can I afford to buy? I have a lot of follow-up questions. How much are you putting down? What's your credit? How much debt do you have? How long have you been on the job? Do you work? Are you working for yourself? Like all of these different things come into play. And I know that's not the answer that somebody wants, but you just have to talk to a lender and see, am I qualified to buy based on the income that I currently make? If not, what do I need to make in order to qualify? Because it might not need to be an increase in income. It might need to be a reduction in debt. And by reducing that debt, now you're qualified. So look at those things with your lender, and then they'll be able to tell you if you're qualified. Somebody making $60,000 a year can qualify, and then I can have another client who's making $100,000 a year, and they don't qualify. So it's not solely based on your income. Keep that in mind. It's not about how much you make. It's about what you're doing with it and how you're managing that money, so that way you can buy. I hope that answers that question. I know I'll kind of go back to the person who asked that and just make sure that that answered that. But when you're buying, you just want to be financially ready. I want to make sure that you're ready When you see these headlines that are out there, how they impact you, you need to have a professional opinion, get professional advice, listen to licensed people, especially online, TikTok and Instagram and all these other things. Don't fall into these Ponzi schemes and all these other things that are going on out there. Really talk to licensed professionals and get licensed advice and expertise. I'm always here. Homeowner Prep was created to help folks go from 0 to 1. This is not a program and an organization that is focused on, you buying home number 10. This is home number 1. Home number 1 is going to be that starter home that helps you get to home 2, 3, 4, and 5, or helps you to start to increase your personal wealth that you can pass down to the next generation. But it's so important, and it's often the hardest home or the hardest purchase that you're going to have. By the time you're buying home 2, 3, and 4, you're like a pro. You know what to expect. You know what's needed. You're already going to have like an agent and a lender and all these other people that you've worked with in the past that you can rely on. But when you're going from renting to trying to buy your first home, you need these resources. You need the advice. You need the expertise. And that's what we're here for. And that's what this show is all about. It's about helping you go from 0 to 1, getting the keys to your first home so that way you can really start to build that wealth through appreciation of that home, and it's working in your favor, not against you. So if you have any questions at all, I definitely want you to reach out to us. One thing I want you to do, if you found any value from this episode or anything that Homeowner Prep has been providing over the years, just share the information with someone. Definitely follow us on all of our social media channels. Connect with us, ask the questions, share with somebody. If you're having conversations on the job or at school, in public with folks who are, maybe they're thinking about buying a home, tell them about Homeowner Prep. That's the only thing I ask. I just want to spread the word and get it out there so that more people can get the information that they need in order to make the transition from renting to home ownership. One thing I can say is when you do follow us on social media, if you click the link in our bio, you'll get access to our link tree. And so I want to make sure that you have access to that so you can get all the links to the resources that you need as well. So this is what our Linktree account looks like. You can get information about our latest press releases, our Future Homeowner Academy. One thing I do want to point out, and it's a good first step if you haven't already done this, is to take our Future Homeowner self-assessment. It's a quick, like less than 5-minute assessment. But what it does is it provides you with a score. And based on that score, it'll tell you just how ready you are to start your home buying process. And so it's a great tool, a great resource. We did recently launch our Future Homeowner Academy back in January. We took on a number of clients and then had to kind of close the door and just open up a wait list because that academy is really about diving deep with folks, walking them through the process and building courses and content that is specific to their needs. And so we recognize that this is not going to be an academy or a community for any and everybody. This is really going to be focused on those who truly want to buy a home. They're on their way and they're willing to do the work that it takes to get there. And so Future Homeowner Academy, right now the wait list is open, but the community is not open. We will open it soon. So if you're thinking about, hey, I need that kind of one-on-one help, then you can definitely visit futurehomeowneracademy.com and you can join the wait list from there. But take action. Whatever the action is, we have resources that are available for you so that way you can start and take that first step towards home ownership. That's truly all I wanted to cover today. This is our first episode of the Future Homeowner Show. I'm looking forward to just giving you more and more content that you can use that's beneficial and valuable to you and helps you to make that decision to stop paying rent, start owning, and get your foot in the door of your first home. So again, if you need anything from us, don't hesitate to reach out. We're always available. Social media, you have our email, and be sure to share this with somebody who can use it. Until our next episode, I hope you have a great day and have a blessed week. Take care.